If you feel like gold and silver just betrayed you, you're not crazy. Over the last few trading sessions, precious metals went from unstoppable to straight-up panic almost overnight. And estimates put the value wiped out across the complex in the trillions. Silver printed one of the most violent drops anyone has seen in modern markets, and gold, the asset people call boring, moved like a meme stock. So today we're answering two questions in plain English. 1. Why are gold and silver tanking right now? And 2. What should you do next, whether you're a long-term holder, a dip buyer, or someone who got caught chasing the rally? Alright, let's talk about what actually happened. In late January 2026, both metals were in full blow-off-top mode. Gold pushed above roughly $5,500 an ounce, and silver tagged about $121. That kind of move doesn't happen because everyone suddenly discovered the periodic table. It happens when money piles into the same trade at the same time. Then January 30th hit, and the market flipped. Silver dropped about 27% in a single session, and within days it traded as low as the mid-$60 before bouncing. Gold also got punched, sliding sharply intraday and then snapping back in the days after. And it wasn't just prices down, it was the speed. Multiple outlets described this as a historic dislocation, the kind of move that, once it starts, feeds on itself. If you watched your portfolio and thought, did something break? Yes, something did break. But it wasn't gold's value. It was the trade. And that difference matters, because it changes what you do next. Here's the simplest way to think about this move. Gold and silver didn't crash because everyone woke up and decided inflation is over, deficits are solved, and geopolitics are peaceful now. They crashed because a crowded, leveraged trade hit a catalyst and then got forced to unwind. Think of it like a crowded movie theatre. Everyone's calm, it's fine, until someone yells, "Fire." Even if there's no fire, the stampede is real. So what was the fire? I see three layers. Layer 1 is the narrative shock. Layer 2 is the leverage shock. And layer 3 is what makes silver uniquely insane. Let's break them down. A big driver of the metals rally in 2025 and early 2026 was fear. And not just normal recession fear, it was policy uncertainty fear. When investors believe monetary policy could become more political or more unpredictable, they rush into things that feel like insurance. Dollars, short-term bonds, and yes, gold. The World Gold Council has specifically talked about how tariff uncertainty, rate cut expectations, and worries about central bank independence can pull Western investment flows into gold. Then, President Trump announced he would nominate Kevin Warsh as the next Fed chair. Markets interpreted that as a shift toward a more traditional, more institutional Fed. In other words, less fear of an aggressively politicized central bank. And here's the key. Even if you personally think that interpretation is right or wrong, what matters is that the market repositioned around it. You could literally see it in the plumbing. Treasury yields in the US dollar rose on the news, which is a headwind for dollar-priced commodities like gold and silver. Now, let's slow down and translate that into human terms. Gold and silver don't pay interest. So the competition for your money is, how much can I earn in cash or bonds? That's where real yields matter. Real yield is basically what you earn after inflation. When real yields rise, because rates rise or inflation expectations fall, the opportunity cost of holding gold goes up. Investors can say, why hold zero-yield metal when cash and bonds are paying me? So part 1 is simple. The trade lost its storyline, the dollar firmed up, and the market started repricing real yields. But narrative alone doesn't explain moves this violent. For that, you need reason number 2. Gold and silver look like simple markets from the outside. Gold is up, gold is down. But under the hood, a huge amount of price discovery happens through futures, options, and leveraged products. And that leverage is like gasoline. When prices rise fast, leverage makes people feel like geniuses. When prices fall fast, leverage makes people hit the eject button, or get ejected for them. 2 things happened at once. First, the trade was crowded. A lot of speculators were long, and some were using serious leverage. Second, the rules of the casino changed mid-game. CME, which is the major US futures exchange for gold and silver, raised margin requirements multiple times as volatility exploded, including increases on January 30th, February 2nd, and again February 6th. And earlier in January, CME had shifted precious metals margins to a percentage of contract value approach. Translation: when the contract price got bigger during the mania, the required cash to hold the contract got bigger too, automatically. And then it got raised again as volatility spiked. So traders had 2 choices. A, wire in more cash immediately, or B, sell. And in a panic, most people choose B. That creates forced selling, and forced selling is not investors changing their mind. It's liquidation. Now add options to that. When the market gets extremely one-sided with call options, people buying upside bets, dealers who sold those options hedge by buying futures. But when the price reverses sharply, that hedge flips, and the dealers become sellers into a falling market. So reason number 2 is leverage plus margin calls plus options dynamics created a liquidation cascade. And in a liquidation cascade, even good assets get sold, because people need cash. That's why you'll often see everything goes down together during a real squeeze. Silver is not just gold, but cheaper. Silver is a weird hybrid. It's part monetary metal, part industrial metal, and the market is much smaller and less liquid than gold. That means when money rushes in, silver can spike harder. And when money rushes out, silver can crash harder. In this episode, retail speculation was a major factor, including a huge wave of buying from China. The Wall Street Journal described how Chinese retail investors, the so-called auntie investors, piled into precious metals as confidence in other domestic investments weakened. And there's another detail most people missed. In parts of the Chinese futures market, daily price limits can restrict how far contracts move in a single session. So when global prices move violently while one major market is constrained or closed, you can get this catch-up effect and a vacuum of liquidity. Now here's what surprised a lot of people. Even after the crash started, retail didn't just disappear. In the 6 trading days ending February 6th, retail traders poured roughly $430 million into the largest silver ETF, SLV, including more than $100 million on January 30th alone. That tells you something important. This wasn't a slow, rational repricing. It was a battle between forced sellers and dip buyers, happening in a market that's simply not built to absorb that kind of emotion calmly. So if you're sitting there thinking, why is silver down so much more than gold? That's why. Silver is the smaller boat in the storm. Now here's where it gets interesting, and where a lot of people get confused. Even as silver's price was getting crushed, some physical market signals actually screamed scarcity. One example. In London, 1-month lease rates to borrow physical silver jumped to around 6% annualized. Lease rates are basically the interest rate you pay to borrow actual metal. When that rate spikes, it suggests the metal is harder to source in the physical market, even if the paper price is falling. This is one of the strangest features of precious metals. Paper selling can overwhelm the price short term, even while physical supply is tight. So you can have a situation where The chart looks like doom, and the physical market looks like stress. Both can be true at the same time. And that leads to the bigger question. Does this crash mean the long-term thesis for gold and silver is dead? In my view, no. But it does mean you need a better plan than line goes up. Let's separate gold and silver for a second, because they don't behave the same. Gold. The long-term case for gold is mostly about confidence. In currencies, in governments, and in the stability of the financial system. Central banks have been major buyers of gold in recent years, and the European Central Bank noted that gold became the second largest global reserve asset by market value in 2024, behind the US dollar. And zoom out to the fiscal side. The US national debt is now above $38 trillion. You don't have to be a gold bug to understand that high debt and high interest costs can box policymakers in. That doesn't mean gold goes straight up forever. It doesn't. But it does help explain why the gold story doesn't disappear just because we had a brutal unwind. Silver. Silver has a monetary angle, but a huge part of the thesis is industrial demand, especially solar. The solar industry has become one of the largest and fastest growing sources of silver demand, and the industry is still scaling fast. According to the International Technology Roadmap for Photovoltaics, global PV shipments hit record levels in 2024. And researchers are warning that, without substitution, solar could become an even larger share of global silver demand over time. Now, here's a nuance most people miss. Solar manufacturers are always trying to thrift silver, to reduce how much they use. But the technology mix matters. Industry sources tied to the PV roadmap show higher silver consumption per watt for TOPCon and SHJ technologies versus legacy PERC cells, even as manufacturers work hard to reduce silver load year after year. So yes, thrifting is real. But the demand engine is also real. Solar deployment keeps scaling, and silver remains a critical input today. Bottom line, the crash did not magically fix debt. The crash did not end central bank gold accumulation. And the crash did not remove silver from solar panels. What changed was price and positioning. Which brings us to the part you actually care about. What should you do? I'm going to give you a decision tree. Not a prediction, a plan. Move number 1. Identify your why. If you own gold or silver as long-term insurance, like you'd own homeowners insurance, then a price drop is unpleasant, but it's not a reason to cancel the policy at the worst moment. If you bought because the chart was vertical and someone promised $150 silver tomorrow, then you were trading momentum. And momentum trades end like this. Same asset, different job, different response. Move number 2. Stop doing the 2 things that blow people up. Number 1. Averaging down with leverage. Number 2. Trying to win your money back fast. A crash messes with your brain. It makes you want to do something. Most of the time, the best move is to slow down. Move number 3. If you used leverage, reduce it. If you are in futures, options, or margin, understand this. The exchange can raise margin again if volatility stays high. Forced selling is how accounts get wiped. Surviving beats being right. Move number 4. Rebalance instead of revenge trading. A lot of people accidentally went from, I want 5% metals, to, I have 15% metals during the run-up. After a crash, your allocation whipsaws again. Decide what percentage you actually want, then rebalance calmly. That's how grown-ups do volatility. Move number 5. If you're adding, think in tranches. Instead of going all in, split your buys into 3 to 5 chunks over weeks or months. Your goal is not to nail the bottom. Your goal is to avoid one emotional decision that you regret for years. Move number 6. Choose the right vehicle. Physical bullion is great for long-term insurance, but understand storage, premiums, and liquidity. ETFs are convenient for liquid exposure, but they can be part of the paper unwind, and you can get whipsawed. Mining stocks can offer leverage to metal prices, but they also add operational risk and stock market risk. They can drop even when metals are flat. Move number 7. Don't get destroyed by premiums. If you're buying physical in a panic, premiums and spreads can get weird. Focus on low premium products, compare multiple dealers, and avoid overpaying for collectible hype unless you're actually a collector. Move number 8. Consider taxes, but don't freestyle it. If you bought near the top in a taxable account, tax loss harvesting can sometimes turn a painful drawdown into a useful loss that offsets gains elsewhere. But there are rules, and you can't just sell today and rebuy the same thing tomorrow without thinking about wash sale issues and professional guidance. Move number 9. Watch the right indicators, not hot takes. If you want a shortlist, the US dollar and real yields, because they often drive short-term moves. CME margin changes, because they drive forced deleveraging. ETF flows, because they show whether the paper crowd is coming back. Physical tightness signals like lease rates and spot premiums, because they show what's happening in the real metal. Let me end with the real takeaway. This crash is a reminder that gold and silver are not magic. They are markets. And in markets, the short term is driven by positioning, leverage, and liquidity, not just fundamentals. If you treat metals like a get-rich-quick trade, you will eventually get humbled. If you treat metals like one piece of a diversified plan, you can survive the storms, and sometimes even use the storms to your advantage. If you want, drop a comment with how you're positioned: physical, ETFs, miners, or none, and I'll do a follow-up on the pros and cons of each setup for 2026. Thanks for watching. Stay safe out there, and I'll see you in the next one.